I am here with Amir Yaron, who is the governor of the Bank of Israel, at a time when we just heard about the ceasefire, President Trump talking about a ceasefire between Israel and Lebanon. You recently have downgraded your expectations for growth as a result of the war. If there are ceasefires on multiple fronts, could you end up seeing some sort of increase to growth based on what you've currently put out there?
Lisa, you're right. We projected growth come down from 5.2 to 3.8 for 2026 under the working assumption that the campaign against Iran and Lebanon will last until the end of April. As long as the fighting both in Lebanon and in Iran, which already has sort of, at least for now, has stopped, we would have to upgrade that 3.8 slightly, and we will have to see exactly where we end up in terms of reserves, in terms of how fast the economy goes back into full action. But there'll probably be somewhat of an uptick relative to our previous estimate. Under that working assumption, we do predict that in 2027 we'll go back to that bounce back growth of about 5.5%. This is, again, reflecting something I've told you. The Israeli economy in general has shown great resiliency throughout this 2.5 years and also through these 40-some days of the, obviously, campaign vis-a-vis Iran.
What's been the main source of the weaker growth than you had previously expected? Is it a lack of tourism? Is it a lack of inbound investment? Is it the stronger shekel? Is there a sense of what's been holding things back?
So first of all, during these 40 days, we had missiles. The missiles imply the education system is closed. The education system is closed means many parents are staying at home. So many things just are not functioning. People don't go as much to restaurants, etc. So that is the immediate effect on GDP. I would say in terms of Lebanon, there we see a lot of boots on the ground, and that implies more people doing reserves duty, and that also, of course, it has an implication on GDP growth. So we take those things in and analyze them, and that's how we came up with the impact that we've projected.
What's the central bank's role in supporting growth during a period of like this, when it's a factor that's completely out of the central bank's hands and doesn't really seem tied to where you take interest rates?
Well, first and foremost at this point, making sure that financial stability is kept, and it has, and we've done what we've done at the beginning of the war and all throughout, making sure that financial stability comes first. And the good news is that the markets, if anything, right now are taking a very positive view on Israel, the strong shekel, the very strong stock market. We've seen that come up with many geopolitical distinct events, from the beepers in Lebanon, the first campaign with Iran, the ceasefire, and the campaign right now. At least the markets are pointing to a very positive geopolitical event. The second part that the central bank has to do, and we are unique in that, we are also the economic advisors to the government. And throughout the 2.5 years, and I'm glad to say the government had listened, certainly in the 24 and 25 budget, to do fiscal consolidation. So debt to GDP does come up, but doesn't, there is a game to make it sure it comes down. We'll have to challenge, to deal with that in probably the next government, because we will have to do some kind of consolidation to see debt come down, military support have what it needs, and at the same time investing in growth engines.
Well, at the same time, the Knesset just passed a budget that actually increased the deficit above where you would have liked to see it.
Right.
I believe north of 5% according to the latest projections. I mean, how much does this tie your hands or make things difficult as a central banker?
So from an inflation perspective, if you ask me, obviously we look at the inflation environment, we look at the geopolitical risk, and we also look at the fiscal impulse that sometimes deficit push. Nonetheless, our projection in that scenario that we mentioned is that even if energy prices, they will affect CPI, but if we look at futures, oil is to be about $80 by the end of 2026. If this does indeed sort of ends within April or by the end of April, we project inflation to be in the low twos by the end of 2026, beginning of 2027, and therefore we signaled that we might be able to do another one or two cuts. Of course, the big issue, as I just mentioned, for Israel is to be back on a trajectory for debt that is coming down. We were fortunate to have a fiscal space of debt to GDP that was 60 at the beginning of COVID, at the beginning of the 7th of October. Given the rate of events in Israel, we should have, again, fiscal space. And the challenge there would be to finance whatever security needs will be needed, and at the same time put the money into growth engines. And that's where the geopolitical outcome is very important. The better it is, the more flexibility we'll have in terms of the spending on security, the more money can be funneled towards lowering debt and into growth engines.
So you recently did 2 consecutive rate cuts. In January was the second one to 4%. And right now you're looking at a shekel that's incredibly strong. At one point, one of the strongest that we've seen going back to 1995, a level that has sort of constrained certain business people in terms of the payment for some of their staff, as well as just the inbound investment, because it's expensive. At what point do you intervene? At what point do you cut rates again, because inflation is already below the 2% target?
So it's a very good question. I would say in terms of FX, it's certainly one of the tools that the monetary policy has at its disposal. But the way we look at it, it's from the lenses of not supporting particular sector, but as a tool to either towards supporting monetary policy, inflation, etc., or making sure that it helps us in the context of financial stability. So at the beginning of the 7th of October, we sold reserves as part of, with the hat and lenses of financial stability. When we were in COVID and we had negative inflation and we were close to zero interest rate, we bought reserves because it was consistent with monetary policy. So we will use it primarily under those targets.
Meanwhile, a lot of discussion here at the IMF meetings, as has been for the number of previous ones, about central bank independence. A real question about how much central bank independence globally is coming under scrutiny just because of the deficit backdrop, because increasingly it is incredibly political how rates go given the financing of a lot of the spending plans of governments around the world.
So no central banks want to be in a position of fiscal dominance. It's clear that a lot of governments are dealing and are trying to create they have less of fiscal space than they used to after COVID, etc. But central bank independence is key for central bank success. What allows us to bring inflation to where it should be. We know that inflation actually hurts first and foremost the weak segments of society, and if there is the credibility and independence, central banks can achieve their targets in a much more efficient and less costly way. And this is something people and other people that are pushing central banks should have in mind, because markets understand that.
From your vantage point, do you think that there has ever been a time where central bank independence was more under threat? I mean, does this feel like a perilous moment, or does it feel like almost the fortification of that independence because of the resounding swell of support from central banks, frankly, around the world? I want to think conceptually. I think the issue of central bank independence is obviously talked a lot about, but I also think there's a lot of understanding in many corridors how important it is, as I mentioned earlier, that central bank independence at the end of the day has brought the results of, while there have been deviations from target, but central bank independence has brought inflation down. And as we all know, if inflation is too high at the end, households, businesses suffer. So it is very important to maintain central bank independence.